Hello, everyone. Adam Bergman here, tax attorney and founder of IRA Financial. I got a special YouTube live video for you today. Back, popular demand. I'm going to tackle the very, very important topic of UBTI, blocker corps, and self-directed IRAs. Now, this is a monster topic that more people should be aware of, just not something that is talked a lot about, just because unrelated business taxable income was really put in the tax code for charities. And I'm going to talk about the UBIT tax, how it applies to IRAs, and then ultimately ways to block it, because that's what it's all about. And this is a very important topic because the UBIT tax, which, as I will explain shortly, is a tax that can go as high as 37%. So it has a pretty large impact on a retirement investment that generally would be tax deferred or tax free in the case of a Roth. So super important topic. So let me just set the agenda for today. I know it's a Friday. I usually do my lives Wednesday, 12 Eastern. But I was traveling this week, so I still wanted to get it in. I try to do these every week. I love them, and people seem to really appreciate them. So that's what I do. I'm a people pleaser. So this is an important topic, and I'm going to keep coming back to this topic because when I talk to my team, my amazing folks in client relations and compliance and clients themselves, this is a topic that keeps coming up. UBIT, blocker corps, how does this UBIT tax apply to IRA or 401k investments, and how the hell can I get around it? So let's just start about UBIT, unrelated business income tax. This was put in the code a long time ago, around the 50s, really to stop businesses like McDonald's from setting up their own charities and running their business through charities and never paying tax. So they set this unrelated business income tax, and the key word is unrelated business. And they said, okay, if you're a 501 tax exempt, like a hospital or some type of charity, and you are engaged in a business activity that is not related, unrelated, to your exempt purpose, we're going to treat you like a business. But on top of that, we're not just going to tax you at the corporate tax rates. We're going to tax you at the trust tax rate, since that probably has this closest equivalence to a tax exempt trust and estates. And in 2023, the tax rates are super high. If you go above $14,451, you're at the highest tax rate of 37%. So the tax rates are essentially this: under $1,000, you pay nothing. Okay, $1,000 to $2,900, you're paying 10%. So once you hit that 1,000 threshold, anything to $2,900, you're paying 10%. $2,901 to $10,550, you're paying 24%. $10,551 to $14,450, you're paying 35%. And then $14,451 and higher, you are paying 37%. So it's quite a big tax. I'm going to put it in the chat. And that's why I'm talking about this. This is super important. So charities. We know why these rules were put into place in section 512, 513, 514 of the Internal Revenue Code, stopping businesses to set up charities, running their business through a charity, never paying tax. So IRS said, okay, we got to stop that. That's not cool. So they put these rules into place. Now let's fast forward from the 50s to 1974. ERISA became law, and part of ERISA, IRAs and 401ks were born. And as part of that, IRAs and 401ks are treated as tax exempts, right? They don't pay tax. They are a 501 type tax exempt. They're not 501Cs, they're 501As. But they're taxed like charities. They do not pay tax, right? If your IRA buys a stock for $1 and sells it for $1 million, no tax. If your IRA buys a house for $1 million, sells it for $20 million, no tax. Money goes back to the retirement without tax. That's known as tax deferral. Now, if you pull the money out and take a distribution, that distribution could be subject to tax and potentially a 10% penalty if you're under the age of 59 and a half. Or in the case of a Roth IRA, if you're over the age of 59 and a half and the Roth's been open at least 5 years, it's all tax free. So the issue is the IRA or 401k is still treated as a 501 trust. And because of that, it gets grouped into these UBIT tax rules. Not the intended consequence of UBIT, right? UBIT was created way before IRAs or 401ks were created. It was created in the 50s, put in the tax code, well before 1974. So obviously it was targeting charities. But unfortunately, IRAs and 401ks are taxed like charities, which is a good thing, right? That gives us an incentive to save along with a pre-tax deduction. The idea of taking advantage of deferral. Your money grows faster without tax. Talked about this a million times. Compounded returns, eighth wonder of the world. Your money doubles every 8 years, assuming an 8% rate of return. It will double faster if you can pull in a higher rate of return. So we got to deal with this, right? I've said the story. I was in DC in October, and I met with members of the House Ways and Means Committee, and I talked to them and said, hey, like, are you guys aware of this, that this UBIT tax is limiting billions and billions of dollars from retirement accounts that could be invested in real estate investments, into private placements, private equity, startups. And this UBIT tax is killing that investment, or really significantly limiting it. What do you guys think about it? And each one of them said, I had no idea. Never heard of UBIT. What are you talking about? So it's a process. The issue is UBIT does bring in tax revenue, right? There is a 37% tax on very low thresholds of income. So it's going to be challenging for members of the House, the Senate Finance Committee to get enough momentum to kind of pull that tax away from retirement accounts. So let's mobilize, let's figure this out, but it's going to be a challenge. So now the goal is, how do you stop this? If not stop it, how do you limit it and block it? So before we get into that, let's talk about really the 3 ways you can limit, or actually 3 ways you can trigger UBIT in a retirement account. The first is an IRA or 401k uses a non-recourse loan to buy an asset like stock, okay, margin. Now, if it's a leveraged ETF strategy, if you're using margin to buy more Tesla stock, that's a loan. Now, I mentioned the word non-recourse. Why must the loan be non-recourse? Because Section 4075 C1B says that an IRA owner cannot personally guarantee an obligation of the IRA. That means they can't personally guarantee the loan. So that's why the loan must be non-recourse. Okay, now, a couple characteristics of a non-recourse loan. Generally, you got to put more money down, right? If it's real estate, you're going to pay more interest, higher interest rates. Why? Lender's taking greater risk, because if there's a default on the loan, the lender cannot go after you personally, right? It's non-recourse. All they can do is take back the property. Whereas if they were able to go after you personally, that's why they ask for credit checks and your tax returns and your W-2 statements, because they want to know what kind of assets you have personally. If there's some type of default and there's not enough equity in the underlying asset, they want to have the right to go after you personally. On a non-recourse loan, you cannot do that. All the lender can do is seize the asset that the loan is connected to, which is why a non-recourse lender is going to ask for at least 30 to 40% down, because they want to make sure you have enough equity. So you're going to also pay higher interest rates. And on top of that, there are certain states that non-recourse lenders don't like to lend to. I'm not saying they will never lend to, but they try not to. Why? These states have very strong tenant rights, very difficult to foreclose. New York, Vermont, California, a number of other states. And if you're a lender with a non-recourse loan out there on a property and you can't go after the individual borrower, all you can do is get the asset back, but there's a tenant in there that won't leave and they're not paying rent, and you want to foreclose, it becomes difficult. So that's not a situation many lenders want to be in. They want to be able to seize that asset, get in, get out quick, and take that asset back, either sell it or rent it out to another person to start recouping the outstanding amount. So that is something that definitely weighs on their decision on the non-recourse loan. So number one, non-recourse asset, generally to buy stock, right? Most people aren't using an IRA to buy inventory. That's not just, or cars or computers, right? They're doing it to buy stocks or equities. Now, option trading. Treasury regulations, IRS, clear. When you buy an option, sell an option, puts, calls, that is not leverage. That is not subject to UBIT. Okay, just to be clear, when you buy options, sell options, that is not subject to UBIT. That is not the same as going out and getting a margin loan to buy more Tesla or getting a loan to leverage up an ETF. That is not what they have in mind, and that is not deemed a transaction that would trigger UBIT. So option trading does not trigger UBIT. Leveraging ETFs, leveraging equities do trigger UBIT. Second way, non-recourse loan to buy real estate. I mentioned why it's non-recourse. I mentioned the characteristics of a non-recourse loan in real estate. There is an exception for 401k plans. If you've been watching these videos, reading my blogs, following me, reading my books, you know that Section 514c9 allows a 401k to use a non-recourse loan to acquire real estate directly without triggering the UBIT tax. Not sure why it only applies to 401ks. The legislative history, this was put in the code in the early 80s. It's not clear. Most big pension plans aren't buying real estate directly. They're investing in it through funds. And there's some language in 514c9 that talks about direct investments in into the underlying real estate and having limitations on if the 401k is investing in a partnership where other members are not pension plans, and whether the 514c9 exception to UBIT would apply. And it's a little unclarity there. So it's hard to know why IRAs are not grouped into this exception. I've spoken to members of the Ways and Means, members of the Senate Finance Committee. I've never gotten a straight answer. And I hit them up. Every time I go to DC, we have an annual conference there for Retirement Industry Trust Association. And we always have someone from the IRS, members of the Ways and Means Committee, or their staff. And I always ask them this question, like, why? And none of them have any idea. First of all, they never even heard of UBIT. On top of that, when I pull and ask more in-depth questions on exceptions, they look at me like I'm speaking in Mandarin. So I still am looking for the answer. And then the third way to trigger UBIT for an IRA or 401k is if the retirement invests in an active business like a restaurant through a pass-through entity like an LLC, limited liability company. And why am I saying pass-through entity? Well, corporations, C Corps, which almost every publicly traded company is a C Corp, that blocks UBIT. And that's going to get into the second segment of this video, blocker corps. Okay, so the word blocker is important. A C Corp blocks UBIT. That's why if you buy ETFs, mutual funds, stocks with your IRA or 401k, you probably never heard of UBIT, this four-letter ugly word, and you never will. Unless you're using margin to leverage up your brokerage account, you won't, because it blocks UBIT. Okay, so that's why, since almost every publicly traded company is a corp, there were some private equity firms that were partnerships, and actually they've switched to C Corps because they were losing pension plan investments because of application to UBIT. So pretty much, as far as I know, there's really maybe a few, but really not more than that are not C Corps. So when you're buying ETFs, mutual funds, most equities, you're buying corps, and that's why you don't have to deal with UBIT, and that's why you've never heard of the UBIT tax, and that's a good thing. But if you want to do private placements, private equity, venture capital into small cap, not small caps, but smaller startups who may not be a C Corp, and there's more than $1,000 in net income allocated to the retirement account from the underlying investment, you could pay this UBIT tax. Okay, so that is a problem. Why is the UBIT tax a problem? I mentioned it. You can go as high as 37% tax on an investment that otherwise would be tax deferred, tax free, right? So if your IRA just bought Tesla and sold it for $20,000 gain, it would go back to the IRA or 401k without tax. If you took that same investment and invested in a real estate fund, a hedge fund, a private placement fund, a venture capital fund that had pass-through income subject to UBIT, that $20,000 could be subject to a 37% tax. Not great, right? No one wants to pay tax on an investment that they would not otherwise have to pay that tax. Not a good thing. You don't have to be a tax lawyer to understand that. So now let's move into the second segment of the video. How do you block this thing? Okay. Now, number one, could you eliminate it? Very difficult. Okay. Before I get into ways to potentially eliminate it, because it brings in what's called a foreign blocker, let me start with the easy stuff. Okay. Domestic blockers. The domestic blockers essentially means you set up a C corporation, your IRA sets up a C Corp, and your C Corp invests into the UBIT activity, whether it's a real estate loan, whether it's an investment into a pass-through entity. The C Corp acts as your blocker. Now, in 2023, a C corporation pays 21% federal tax. Depending on the state, there could also be state taxes. But if you set up your corp in South Dakota or Delaware, Wyoming, you're not going to have any state tax. So you're looking at a 21% tax. 21% tax is okay. It's not perfect. We'd all rather pay zero. Okay, right? Zero is less than 21. But 21 is better than 37. Okay, so not ideal, but you're going to see once I start talking about foreign blockers, the domestic blocker, in my opinion, is your best solution. 21% is not horrible. It's basically a high capital gains tax rate, right? If you make less than $650,000 of income, capital gains tax rate is about 15%. Once you're above that, you're looking at about 20% plus there's some Obamacare stuff, so around 23.8%. So 21% is not horrible. It's basically a capital gains tax, right? If you sold your business, pay 21%. Now, if this investment activity, this real estate fund, this private placement, the hedge fund, private equity, this fund that's going to be, or investment that will be triggering the UBIT, if that's going to get you a really good return, like 12, 13, 14%, then the 21% is not a killer. If that investment getting you 5% or 6%, then obviously don't do it in a retirement account, because the 21% on the blocker or the 37% kills the juice, right? Just kills your investment. You might as well just buy stocks in an IRA. UBIT hurts, but it hurts a lot less when you have a blocker and you can generate 10, 12, 15% returns. Then it hurts less, right? So you can get a 12% return, 21%, let's say it's about 2.5%. You're looking at almost 10%, 9.5% return on the investment. Not horrible, right? That looks a lot better when you can get a 13, 14, 15% return, which there are not a lot, but there are a good number of private equity, hedge fund, real estate funds that can get you that 15, 16% juice. Even if you can block it with 21%, you're still doing really well. Okay. 37%, no good, right? I don't love UBIT. I've been honest with people for the years. I've told people sometimes it's better to use personal money. I spoke to someone, it's Friday today, maybe Monday or Tuesday. Really smart guy. He was talking about a private equity deal, and it was like a 250 investment. And he had money, successful guy. He had money, personal funds. He wanted to use his IRA because he just thought it was going to be a great return. And we talked about UBIT. This private equity fund was probably going to use leverage, no blockers, and the underlying investments, which is strange because most private equity firms are investing in larger companies that tend to be corps. Venture capital funds, their investments in many cases are flow-throughs, but the bigger the funds are, they don't want pass-through losses. They're okay investing in C corps. So in a lot of private equity, venture capital, especially your big deals, big funds, a lot of the underlying entities are going to be C corp. So you're probably not going to have to worry about UBIT. But in this case, there was going to be a UBIT issue. And in fact, this guy just was like, you know what? I'm just going to use personal funds. I don't want to deal with UBIT. It's cool. I get it. But for other folks that just don't have that opportunity, they don't have that option, right? They want to use their retirement money. That's their best course of action. UBIT's super important. So the blocker, the domestic blocker, you're doing basically moving from 37 to 21. Okay. And then essentially you have your IRA or 401k, invest in a C Corp. We set up the C Corp, no big deal. We provide you bylaw, shareholder agreement. I'd suggest doing it in a state with no state tax. If you choose South Dakota, we have an office there. You can use our address. We'll serve as your registered agent, no fee. And then that corporation makes the investment into the underlying investment that will trigger UBIT. And this way you file an 1120, you pay your 21%, you're done. You don't have to worry about 37% UBIT. How do you file UBIT with the IRS? April 15th, you have to file a 990T. We actually have a tax filing service that does it for our clients, which is awesome. So it's not a major issue from a tax filing standpoint. It's really the tax, right? 37% tax. No bueno, no good. No one wants to pay that. 21, obviously a lot more appetizing, and the setup of the C Corps is not significant. So it's not like you have to set up a foreign corp, which we'll get to in a minute. So with a domestic blocker, all you're really looking at is reducing the 37, to 21%. And for most folks, that's just a tax they'll deal with, especially if they're going to be able to generate a strong return, 10% plus. That 21% is not a killer. I wouldn't suggest doing blocker corps if you're getting 4 or 5% returns. I probably wouldn't do it in the IRA because it doesn't make sense to trigger UBIT on a 4 or 5% investment. Now, remember, you have to have net income. A lot of investments, especially startups, venture capital, real estate investments, don't have net income for the first many years. Why? Lots of expenses, whether it's paying off loan, depreciation, other expenses that you can use in order to reduce any of the UBTI. So for some investors, UBTI is not an issue to the end. When I say the end, I say when you sell the asset. Now, the way the leverage works on a capital gain sale is if the loan is outstanding within 12 months of the capital gain sale, even though it's a capital gain sale, still subject to UBIT because that loan is in existence within 12 months of the sale. Now, otherwise, if the loan has been paid off years in advance, then you've used leverage. The real estate or the investment didn't have a lot of net income. You paid off the loan, and now you have that asset with no loan outstanding. Now you're good to go, right? Now there's no UBIT. So it's important to kind of strategize and figure things out. One thing I want to be clear, if your investment does not have leverage, okay, and it's not invested in a pass-through entity, you're probably not going to have UBIT. So if you're investing in a corp that's generating dividends, if you're investing in an LLC that has interest, if you're investing in an LLC that's not a business, right? It's just maybe a hedge fund with no leverage that's just buying and selling stocks and that generates capital gains, no UBIT. Dividends, interest, capital gains with no leverage, rental income with no leverage, royalties, no UBIT. UBIT, again, you need the leverage or you need a pass-through business that has income over $1,000. Those are the two things you got to be focused on, okay? Again, you can block it. You can reduce the 37 to 21, which is good. It's not zero, but 21 is not horrible. Now let's move into foreign blockers. Now, I'm just going to preface this. I'm not going to get into weeds on this because just to let you know, obviously, I'm a tax lawyer, okay? I have a law degree. I also have a master's in taxation, okay? I've taken multiple international tax classes, foreign tax 1, foreign tax 2 at NYU, 20 or so years ago. And those are the 2 hardest classes I ever took in my life, okay? Subpart F, international tax, is extremely complicated, extremely, okay? That's why only large law firms and very sophisticated tax lawyers even want to meddle in international tax stuff, okay? So if you're looking to do a blocker, foreign blocker, beware, okay? Because you're going to be dealing with potential tax issues like FERPTA, like branch profit tax, like tax treaties, baby, okay? Scary stuff. So let's break it down. I'm going to start not real estate because real estate brings in what's called FERPTA, Foreign Investment Real Property Tax Act, and branch profit taxes potentially as well. And essentially, if you're a retirement account, using a foreign blocker because of FERPTA and branch profit tax doesn't make sense. The only time it makes sense is if you're a non-U.S. person and you want to block the application of the U.S. estate tax. Setting up a foreign corp could help. It will block the estate tax. But that's for individuals. Retirement accounts don't pay estate tax. They're not individuals. They're subject to estate tax on the individual owner side, but not individually as a party. So let's start with non-real estate. So let's say you're investing into a hedge fund, okay, and you want to reduce the 21% even further. Could you set up a Cayman Corp, BVI Corp, British Virgin Island Corp, or a Corp in a jurisdiction with no tax, like Cayman, and then invest that foreign Corp into the hedge fund? Sure, right? You can do it. No one's going to stop you. You got to report it. But if the hedge fund is not a business, right? So it generates fixed determinable income like capital gains or interest. Could it work? Now, potentially, yeah. Capital gains tax is not subject to a withholding tax. So if you generate interest, dividends, royalties, rental income from a U.S. business and it goes to a foreign person like a foreign corp and there's no tax treaty, generally it's a 30% withholding tax. That's why people have to file a W-9. The W-9 tells the U.S. party that the person that's the recipient of this income is a U.S. person or not. So if it's a U.S. person, there's no backup withholding tax of 30%. If it's a non-U.S. person, there will be backup withholding tax of 30% unless a treaty reduces it down. Cayman, BVI, tax-exempt jurisdictions do not have tax treaties with the United States. There's a reason for it. So if you use a blocker corp, BVI or Cayman, invest in a hedge fund, and all they have is just capital gains transactions, you may be able to get around branch profit tax. Definitely FERC does no real estate, and potential backup withholding if all you're generating is capital gains. But if you're generating dividends, interest, royalties, rental income, the backup withholding tax of 30% will kill you, right? Okay, not a good thing. So there are ways that some very sophisticated funds will use some type of leverage stripping where they'll allow the investors to lend money in and also invest through a foreign corp into a domestic corp to reduce the amount that would be subject to backup withholding. But let me tell you, that cannot be customized. That's super, super focused on the fund, and only very large funds, very sophisticated funds that attract foreign investors or retirement accounts will deal with that. Most funds will not. Okay, and I don't want to even get into it because it's super complicated and it's going to put you to sleep. It's just, for the average investor, it's just not relevant. Okay, so now let's move to, we talked about hedge funds. What about a private equity or venture capital fund that's investing in active trader businesses? Okay, so you have a foreign corp from the Cayman that's going to invest into a U.S. fund. Let's say it's a pass-through that will invest in businesses. So you're going to be generating business income. Okay, so that means the U.S. company will pay tax on the business income, the fund, but then there's something called a branch profit tax. The branch profit tax basically wants to put the foreign party and treat them like a U.S. party. So what it does is it imposes another tax, which can go up to 30% on any of the retained earnings from that fund that's not dividend out, essentially a dividend equivalent tax. So essentially what it's doing is adding a potential 30% tax. Could be reduced by treaty, but it kills the use of the blocker, right? Because now you're paying U.S. tax and potentially a 30% tax. You might as well just do a domestic blocker and just pay 21%, right? Why the hell would you do a foreign blocker and add 30% to it? So that doesn't make sense. Now, real estate. Let's talk about real estate. So foreign corporation invests into a real estate fund, pass-through. Okay, what happens? Rental income is going to be subject to withholding tax, at least 30%. They sell the real estate, it's going to be subject to FERPTA, right? Because you have a foreign party that owns direct interest into U.S. real estate. And even if the foreign company owns a U.S. company, the stock in the U.S. company is going to be deemed to be a FERPTA company because it's a indirect interest in U.S. real property through the ownership of the C Corp. FERPTA is basically a 15% withholding tax on the gross amount. Could be reduced to 10, but it's a 15% tax. Big tax, right? $1 million, 15%, big tax. You got to file a tax return, potentially, pain in the rear end, okay? Potentially also a branch profit tax, and then maybe a withholding tax on dividends. So what am I trying to get here? I'm trying to say, without spending the next 12 hours talking about the foreign tax regime, it is super complicated. It was put in place in 86 beyond to stop foreign parties from getting involved into U.S. investments or even U.S. parties using foreign entities to invest in the U.S. circular without paying U.S. tax. They punish you. Okay. So what I'm trying to tell you is if you have an IRA or 401k, you want to reduce or eliminate UBIT, a foreign blocker is probably not the answer. The only time it will work is if you're literally just generating capital gains transactions from non-real estate, basically a hedge fund or an investment fund that generates, crypto fund that generates just capital gains. If you're generating rental income and interest in real estate, dividends, interest, that will be subject to backup withholding, plus potentially a FERPTA tax, maybe even a branch profit tax. The foreign corp will be a disaster. Could go up, the tax could go up to like 60%. Disaster. You never want to go there. So in my estimation, in most cases, I believe if you're looking to do a UBIT transaction and don't want to pay 37% tax, the best thing you can do is do a domestic blocker. You got to run math. It's 21%. If you do it in South Dakota or Delaware or another state like Wyoming, no state tax. That's all you're going to do, 21%. It's like a capital gains tax. Not the best, not 37%. Foreign blockers could be a nightmare. And besides, there's a huge cost, right? Setting up a Cayman Corp, administering the BVI or Cayman Corp costs you 10, 15K a year. On top of the fact you may pay 60% tax. The only time it works, as I mentioned, is a hedge fund or you're investing in a large real estate fund or private equity or venture capital fund. And they know how to get into some leverage stripping and basically using a loan in, because the loan is not subject to UBIT, and limiting the backup withholding to under 21, trying to be under 20%. But it's tough to do because you got to mix leverage versus equity. Not easy to do. And it's only for big investors. So for the average American with a couple $100,000 in an IRA that wants to do investment to that will trigger UBIT. And how do you trigger UBIT again? Asset that will have leverage, an investment that have leverage through a pass-through, or investing in a pass-through business generates more than $1,000 in net income. C corps block it. Pass-through, I mean LLC. S corps are no good because IRAs can't invest in S corps. So generally, we're talking about LLCs, partnerships. UBIT if it's business income or there's leverage, and if there's real estate, you're also dealing with every real estate fund will have leverage. So you're going to be dealing with leverage. So just to put all this together, UBIT sucks. It's a 4-letter word. In some cases, it's a killer. You better off do it with non-retirement funds. But there are ways to reduce it down to 21%, especially if you're going to be able to generate 10 plus return. 21% tax is not the killer. Pre-2017, the corporate tax rate was 35%. So the blocker strategy didn't really work. The only way it worked is if you had less than 50K of income pre-2017, the tax rate was 15%. Now, the Trump tax plan from 2017, everything's 21%. 21, again, it's not horrible. It's not the best. It's not horrible. And you can limit the application of the UBIT down to 21%. So in most cases, I personally believe that's the best result. That's what people should be focused on. They really want to do their investment. There's going to be UBIT. Think of the C Corp blocker. 21% tax if you're generating 12, 13%. Not horrible. Not the end of the world. We even have a tax filing service that can assist you with that. So the 1120. So not the end of the world. And at least you can do your deal and not have to worry about 37% tax. So ultimately, I think that's the best course of action. That's what I believe is probably the most fruitful path for most retirement investors. Now, UBIT's complicated. Again, I personally think I'm not objective. I built IRA Financial. I founded the company. I think it's one other reason that sets us apart. Like, this is the kind of education information that we provide all our clients. We have an amazing team of client relations and compliance members that are super smart, and we focus on this stuff. Okay, we don't only just do tax filing services, but we're going to provide you this type of advisory services, and we're going to help you issue spots. So yeah, I truly believe everyone that sets up an IRA should use IRA Financial. In fact, I get disappointed whenever I hear someone that uses a different company. I'm just like, why? But I get it. I understand. But I truly believe we're special, and our fees are super reasonable, probably on the low end, and the type of expertise and advisory filing services you're going to be getting like is second to none. So if you haven't set up an IRA or 401k and want to do alternative assets, like I think you'd be dumb not to choose IRA Financial. But hey, I'm not objective. Okay, let me get some questions. Crypto tax. Okay, IRAs don't pay any tax. So if you buy and sell Bitcoin or Ethereum, there's no tax, right? It's a capital asset. Cryptos are treated as a capital asset. It's treated as a property, like real estate, like stocks. So you're not dealing with any tax. UBIT is based on the percentage of the assets as leverage, correct? So, right. So if you have $50,000 of cash and $50,000 of leverage, it's 50-50 debt to equity ratio. So if I own a 500K property with 250K loan, and I put UBIT on 50K of net revenue. No, it's net income. So Daniel, the IRS is kind enough to let you take into account your allocated share of depreciation, other expenses. So if 50% on your example is debt finance, you get 50% of depreciation, 50% of expenses, whatever the case may be, to reduce your UBIT lower. So in a lot of cases, people are kind of calculating UBIT in their head. In many cases, it's a lot lower than you think because you do get to take into account your allocable share of expenses like depreciation or even accelerated depreciation. So it's not perfect, but in a lot of cases, the bite is not as bad as you first perceive it to be. But again, the strategies is the blocker. If you don't want to use the blocker for whatever reason, because you think net income will be zero for the next 10 years, that's cool too. Other strategies is, hey, I'm going to keep my net income below $1,000 if I can. Spend the next 10 years paying off my loan. Trying to get super high loan payments as high as I can go. If there's no prepayment penalties, just paying down the loan as quick as I can. Ultimately get to a situation where I have no loan outstanding. And then if I sell the asset, there's no UBIT so long as the loan has been removed 12 months prior to the sale. If you're doing a hedge fund with no leverage, which is rare, right? Most funds use leverage, whether it's buy real estate, whether it's to invest in stocks or equities, because you just can buy more with leverage. So that's why a foreign blocker to just eliminate UBIT is almost impossible because there's always leverage in a fund. But it's possible if they're just buying and selling assets and there's no dividends, interest, rental income, or business income. It's just technically possible just to block it. But it's difficult. And that's why you want to work with a company like IRA Financial or talk to the plan sponsor and ask them these questions. What's the big issue of UBIT and why I've talked to the members of the Ways and Means Committee and some members of the IRS about removing it for IRAs and 401ks is it's impossible to police it. Why? Because if you go into a small fund, the only way the IRS is going to know there's leverage out there is basically off a K1. A K1 is what the partner in a partnership receives, right? It says your income, provides you the IRS a snapshot of the partner's capital account and any income allocated to that partner. But if the partnership isn't notifying the IRS and identifying on the K1 that there's UBIT, it's going to be hard for the IRS to notice it. Now, if it just says business income and the IRS sees that the partner's an IRA, because they could see that either because it's titled IRA Financial Trust Company for the benefit of the Adam Bergman IRA, or it's an LLC checked off as an IRA, single member LLC, where you identify the party as an IRA, pass through. It'd be almost impossible for the IRS to identify that UBIT would apply. Generally, the fund would have to indicate that there's UBIT. Most funds don't treat their income as business income, as passive income. So if there's no, I believe it's box 25, I think it's code U or V. If that code's not in there, there's no way the IRS is going to know there's UBIT. So that means most of the stuff just doesn't get really reported because it's not really the IRA and 401k participant doesn't even know sometimes there's UBIT. Whether they don't know the sophistication of the fund, maybe they should, maybe they don't. And it's not reported on their K1, so they can't report it on the 990T. There's no way they can pay it. So a lot of stuff never gets reported. The big funds will report. Some big funds won't take retirement accounts or charities or they'll make them use a foreign blocker or a domestic blocker because they want to deal with UBIT. And that's why, again, I just think the C Corp is, the C Corp, domestic C Corp is really the best way of going about it, honestly. It's 21%, but at least you kind of know what your costs are. You know what the expenses are. You say, okay, I'm going to get 10, 12, 13%. I know I'm paying 21%. I can sleep at night. I know what it is. I don't have to worry about UBIT. Oh, my God, the promoter of the fund didn't give me the right information. I don't have it. My accountant's on me. I don't know what to file. We do the filings, but we can't file without the information. So I think the C Corp blocker is the way to go, whether you're investing in a real estate fund, a private placement, flow-through entity that generates leverage or active business income. Personally, if you're going to generate more than $5,000 in net income, I really would use the blocker, right? I put the trust tax rates into the chat, right? You don't have to be a genius to kind of figure it out. Once you're above the 5,000 or so bucks, like the 21% makes sense. This gentleman wrote, yeah, I agree with you, Anthony. Look forward to working with you. But yeah, I think that's what separates us. Like, we're going to give you all information. I can't tell you over the last 13 years when I've been in this industry, how many people said, Adam, I worked with another company. They were great, but no one told me about this UBIT. And now I haven't filed a 990T in 10 years or 5 years. I'm worried, will the IRS go after me? What's the deal? And it's a problem. Generally, the IRS has a 3-year statute of limitation. The problem is, when does it start? Because you never filed a return. So does it start when you receive the K-1? Because otherwise, the toll will never start because you never filed a 990T. So is the 3 years ever going to lapse? It only starts when you file it. Does it start when you receive it? A little bit of uncertainty. So my thought is just get around UBIT, use a C Corp blocker, and sleep well at night and just deal with it. But yeah, I think, again, this is something that we feel really strong about. Now, just to rephrase what I said, once you're at $2,900, you're at 24%. So literally, if your investment is going to generate more than $23,000, like, you'd be dumb not to do a C Corp blocker. Honestly, it really makes no sense. So that's kind of it. I appreciate the comment, Anthony. We do take pride in making sure all our clients have all the information. Ultimately, it's your decision, right? If you say, Adam, I don't care what you said, I want to pay UBIT, like, I'm not doing a C Corp, no worries. It's a self-directed account. Whether you want to buy Zimbabwe dollars or invest in XRP or buy real estate in Lebanon, it's your call, right? It's not the IRS position. It's not my call to say you can or cannot do it. Our only role is to make sure that you understand all the rules on prohibited transactions and UBIT, right? It doesn't just stop at prohibited transactions. UBIT could be a tax killer, right? You can turn a very tax-efficient investment into a nightmare, 37% tax. So hopefully you guys got all the information. It's a really big topic. I'm going to keep focusing on this. I can talk about foreign corp blockers for hours, but it'll probably put you to sleep. But my thought is just don't go there. Unless you're going to use and invest in a very sophisticated fund that already has their own foreign blocker, you don't want to set your own up. I think it's crazy. I would do the domestic C Corp blocker all day. Whether you're investing in a domestic, crowdfunding real estate platform, we've partnered with a number of them. Really good companies have some really good deals. 14, 15, 60% returns. This way, at least you can reduce that down maybe 13, 14%, but it's still better than a 37% tax. I've been a client for years with the Pastor LLC. Thanks for the service you provide. Just trying to find out if I should convert to a Corp. Well, Daniel, you may not have to. If your IRA LLC is generating passive income like dividends, royalties, interest, rental income, there's no leverage, and it's not a business, you're good to go. You don't have to worry about UBIT. Remember, UBIT only gets triggered 3 ways. Leverage to buy an asset through a pass-through entity, leverage to buy real estate through a pass-through entity, an exception for 401ks, or if you invest in an active business through a pass-through entity. So either leverage or a pass-through entity or both. That's it. If it's an LLC invests in rental, flips, real estate, Airbnbs, cryptos, hard money loans, and there's no leverage and there's not a business, you're good to go. You can basically just turn the video off right now. Sorry you wasted the last 45 minutes of your day, but no, it's good to know. This stuff is important to understand. And it's just the more information you have, the better, because you never know what investments will pop up in the future. I want to use it for investing in apartment syndications in the general partner side. Okay, well, we'll talk about that, because if you're going to invest on the GP side, you're just going to get a carry. There's no leverage, but there's ways to do it, and smart ways to do it without triggering privilege or transaction rules. In your case, Anthony, I'm not worried about UBIT, because the GP is not going to have any leverage, but it's going to generate a carry, a strong return, management fees. Management fees could trigger a UBIT, but the carry may not. But we need to structure it the right way, because we don't want it to trigger a privilege transaction rule. So reach out to me, Anthony, and ask for my email. Whoever you're working with, send me an email. We'll chat. That's what we're about. I'll talk to anyone, even if you're not a client of IRA Financial. If you have a question, I will never say no. I may not spend 3 hours with you on the phone, but if 5-10 minutes, I'm more than happy to talk to anyone. Email. Obviously, you can hit me up on LinkedIn. I get a lot of questions on LinkedIn, and I do my best to respond. You can leave a comment on this video or podcast, and I'm happy to coordinate a time and chat, or just communicate through email. The most important thing is just getting everyone the right info. Education power. I believe the more people we empower, enlighten on the power of the self-directed retirement industry, the more people that will want to save, because they'll be able to invest in investments they know and trust, right? The people I talk to that aren't focused on retirement saving, it's usually because they're just like, I don't like the investment options. I don't really want to wait 30 years to see my millions. And they don't focus on it. But if you tell them, hey, you can do real estate, you can do cryptos, you can do gold, you can do hard money loans, you can invest in your friends' businesses, or your neighborhood gym, your coffee shop, brother's business, sisters, there's really only very few things you can't do. People get excited. They're like, oh, this is cool. This is actually, I can do something fun, and it's going to grow without tax, and I could potentially have hundreds of thousands, if not millions, when I retire. Like, I'm in, and I'm going to be part of the self-directed retirement nation. So it's a great nation. We're growing, millions of amazing, smart people. So thanks for being a part of it. Thanks for watching today's video, and have an amazing, amazing rest of your day. Take care.